Welcome to your Money Your Way YouTube channel. Today, we are exploring a fascinating topic that's affecting global markets: tariffs. And more importantly, how savvy investors can navigate these stormy economic waters. In the next few minutes, we'll dive into 3 Singaporean stocks that are well positioned to face the challenges brought on by international tariff pressures. Stick with me as we break down each company and see why limited exposure to tariffs might just be the edge you need in your portfolio. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's start by setting the stage. Recently, President Trump introduced a wave of tariffs affecting more than 180 countries, a bold strategy that some have dubbed the Liberation Day tactic. Although these tariffs have been paused for a 90-day period and are currently set at a baseline of just 10%, the broader uncertainty has left global markets on edge. Investors are now looking for ways to protect their portfolios from this volatile international trade environment. One smart approach is to invest in companies that serve mainly local or regional customers, businesses that aren't heavily reliant on exports and are less affected by these cross-border fees. Our first candidate is none other than Seng Sayang, trading on SGX under the code OV8. Many of you know Seng Sayang as one of Singapore's largest supermarket chains, with an impressive network of 77 outlets primarily located in heartland areas. What makes Seng Sayang stand out is its unwavering focus on serving the local community. In 2024, they reported a robust revenue of 1.4 billion Singapore dollars, a 4.5% increase compared to the previous year. Their operating profit also saw a modest rise of 2.7%, and net profit increased by 2.6%, buoyed by an improved gross margin that climbed from 30% to 30.5%. But that's not all. Seng Sayang generated a free cash flow of 200.8 million Singapore dollars, marking a 20.3% increase over the previous period. The company is also rewarding its shareholders with a dividend that increased slightly from 0.0625 Singapore dollars to 0.064 Singapore dollars per share. And with plans to double their store expansion, opening 6 new outlets last year and 2 more in the first 2 months of this year, plus a potential tender for 8 additional HDB stores, this local player is clearly poised for growth despite global tariff headwinds. When a company is deeply rooted in domestic demand, it becomes a safer harbor in uncertain times. Next on our list is Yeo Hiap Seng, also known as YHS, which you can find on SGX under the ticker Y03. This iconic brand has been quenching thirst for over a century, offering a unique range of Asian beverages, from traditional soybean drinks to soothing chrysanthemum teas. In 2024, YHS weathered some challenges, with its revenue dipping by 1.2% to reach 328.6 million Singapore dollars. However, not all the numbers painted a grim picture. While revenue dropped slightly, YHS managed to boost its gross profit by 0.9%, with its gross margin rising from 32.5% to 33.2%. On top of that, their net profit grew by 3% to 6.9 million Singapore dollars, indicating that the company is maintaining healthy profitability despite fluctuations. The majority of YHS's sales are focused on Asia, with exports to markets like the US accounting for just 2.7% of total revenue. With a positive free cash flow of 14.1 million Singapore dollars, YHS remains committed to optimizing its product mix by emphasizing higher margin items, driving overall efficiency, and searching for new opportunities in emerging markets. This strategic focus on regional markets helps shield YHS from the global tariff storm. Last but not least, we have Propnex, trading as SGX, OYY. Propnex stands as Singapore's largest listed real estate agency, with an incredible roster of over 13,000 professional salespersons. Their expensive services range from real estate brokerage and training to consultancy, extending across Singapore, Malaysia, Indonesia, Vietnam, Cambodia, and Australia. Now, 2024 wasn't a walk in the park for Propnex due to some challenging property cooling measures in Singapore. Their revenue slipped by 6.6% to 783 million Singapore dollars, with a noticeable 12.4% dip in gross profit, landing at 71 million Singapore dollars, and net profit dropping by 14.4% to 40.9 million Singapore dollars. However, despite these setbacks, the company generated a robust free cash flow of 37.7 million Singapore dollars. Investors also received a total dividend of 0.0775 Singapore dollars per share, a combination of a final dividend of 3 cents and a special dividend of 0.025 Singapore dollars. Looking ahead, Propnex remains optimistic. They forecast a healthy 5% to 7% growth in the HDB resale market in 2025, with volumes expected to hit between 29,000 to 30,000 units. For the private home market, they anticipate a modest price rise of 3% to 4%, with around 8,000 to 9,000 units changing hands. With developers poised to launch approximately 13,000 new units, including executive condominiums next year, Propnex is preparing to regain its momentum by capitalizing on evolving market trends, even as global tariffs continue to cause ripples. Let's recap today's discussion. In an environment where global tariffs and trade uncertainties loom large, choosing stocks with limited tariff exposure has become a strategic imperative. Here's a quick summary of our 3 picks. Sheng Siong, trusted local supermarket chain with steady revenue growth, expanding store presence, and robust free cash flow. Yeo Hiap Sung, a century-old beverage brand with a dominant focus on the Asian market, maintaining healthy margins and prudent financial strategies. Propnex, despite facing market headwinds due to cooling measures, this real estate giant is poised to benefit from a revitalized property market through targeted initiatives and sound financial management. Investing isn't just about chasing high-growth stocks, it's also about securing stability in turbulent times. By focusing on companies that serve primarily local or regional markets, you may be able to insulate your portfolio from the unpredictable impacts of global tariffs. What do you think about these 3 stocks? Are they a fit for your investment strategy? Drop your thoughts in the comments below. If you enjoyed this deep dive into Singapore's resilient stocks, don't forget to hit that like button, subscribe to Your Money Your Way for more financial insights, and share this video with your network. As always, stay informed, invest wisely, and I'll see you in the next video.